you know that the primary determinants of the return that you achieve on your portfolio are not the results of the stocks that you have particularly selected, but rather the assets that you have allocated your funds to? Hey, this is Shayan and you are watching The Smart Ticks. Let's come to the subject of the video. This is not about the top 5 or the top 10 investment advices that you will find floating around in the YouTube from the different investment gurus or in the different news channels. This video rather is about one key aspect or one key service that you'd get if you had paid quite a sum of money to a portfolio manager or a fund manager to handle your account. This service or the key aspect that I'm talking about is actually a document called Investment Policy Statement or IPS that is actually used to build a framework for the real big investors, the institutional investors, or what are we call the intelligent investors, the big boys. Retail investors like you and me often run after the multi-bagger. What is the next big talk of the town? What is the next buzzword in the stock market? Whether it's Bitcoin or Ethereum or HDFC or whatever may be the script. But you need to understand one very key aspect over here. The buzzword or the investments or the instruments that make most of the noise have already achieved most of their true potential. So once you have got to hear about them, it's already hot. It's like catching a falling knife. So you will only bleed your hands, nothing else. In this frenzied time, when you see your friends and your acquaintances posting on Facebook about different investments, be it on Bitcoin, where you see multiple people posting that they have gained huge sum of money, or some people posting about the stocks that they have invested in last March in 2020, from which they have grown more than 100% in equity. These kind of assertions cloud your judgment. Whenever you find such kind of proclamations and you find yourself drawn towards it, you need to take a step back. You need to contemplate, is this the train that I had originally thought of boarding? Or even if I had, is this actually the best time of boarding it? You need to think about whether the stock has already achieved its true potential, whether the event, whether the catalyst that was due to happen, which would lead the script or the instrument to achieve its true potential, has already happened. The expectations has already been met. Next question you need to ask yourself is whether this investment truly fits your investment philosophy. Now you'll ask, hey Shan, I don't have any investment philosophy. I just board the whatever the next bandwagon happens to be on, and I just simply look to make the most out of it. But let me clarify one thing to you. I really love to break to you that you do have an investment philosophy. You just don't know it because you don't have it documented. The real professionals like the fund managers, the portfolio managers have these policies documented in what we call the IPS, as I already mentioned. Now, when you are trying to figure out your own investment philosophy in order to write that in your IPS, you have to figure out what is your risk appetite. What is the framework that you are most comfortable in? Are you someone who is not completely comfortable in investing in equity, whose most of the allocation so far has been in FDs or in bonds or in corporate bonds or in treasury bonds, etc.? If that is the case, then probably equity is right away in terms of single stock selection is not the right path for you. Now, I'm not saying that the asset allocation you already have is absolutely the correct one. That's not my intention. What I'm saying is, whenever you are trying to pivot, whenever you're trying to switch or transition, you need to make it smooth, and you need to make each and every parameter of this investment known to you. You have to know the features, you have to know the risks that it comes with. You have to know the horizon that you have to have in order to invest in that kind of asset class. So without knowing those, you cannot jump into that instrument just by following someone else who has achieved a lot of return in that asset class or a particular script within that. Now understand this, your risk framework or your risk philosophy consists of two major elements. One is your risk taking ability and the second is your risk appetite. So when we talk about a risk-taking ability, it's necessarily quantitative. You have a huge home loan to pay over the next 20-30 years. You have an education loan to pay off. You have a car loan to pay off. You don't have enough dispensable income in order to play around with, or which you afford to lose. So your risk-taking ability is low. You may have a very high inclination towards risk. You may play in Rummy even, but that does not change the fact that your ability to take risk is low. So a person will not be a portfolio manager or an investment advisor will not be able to put Bitcoin even in small amounts in your portfolio because you don't have enough money that you afford to lose. So what if I have a lot of risk-taking ability but I don't have the risk appetite? So that is something that you have to come in terms with. Either you talk to me or your any investment advisor that you can find who is sane enough and who you think is rational and do not hold enough amounts in that particular script that you want to get invested in. You can take suggestion from him regarding how to increase your risk appetite. For example, I have a lot of friends who have a lot of earnings coming in, but they invest everything in bonds and mostly in fact they put all their money FDs, which I don't count as investments. So essentially their risk-taking ability is quite formidable, but their risk appetite is low. So you need to come in terms with what is the combination of your risk appetite and your risk-taking ability, and based on that you need to decide what kind of instruments will rightly suit you. To understand the characteristics of different instruments, you need to go through the characteristics of those asset classes first and then those particular instruments. So for example, in an asset class of bonds, first you have to understand the different risk characteristics and the return characteristics of that particular asset class. Then you have to go to the particular instrument. Now what does your investment philosophy or the IPS helps in is when you have this entire framework chalked out, when you have the entire system completely stratified and written down in a well and cogent manner on a piece of paper, anytime you deviate from that philosophy in terms of the instrument or in terms of the asset class that you want to get invested in, there will be a knock on your door. You will be able to understand that I am diverging from the set of rules that binds my investment philosophy. If I want to diverge from it, I need to set aside a particular timeline within which I want to diverge from it. That is called tactical. Tactical allocation is separate from strategic allocation. So your philosophy determines your strategic asset allocation. That is your long-term asset allocation that in fact holds true throughout your entire horizon. Then based on certain opportunities that the market presents itself, you can sometimes within a certain time frame deviate from it based on the opportunities, their risk characteristics and your risk appetite. So that is called tactical. You need to be very certain of the way and the time horizon for which you want to deviate from your original course that you had set your path upon. If you have watched this video till now and you are enjoying what I am sharing, please give it a big thumbs up and keep watching. I'm in fact a retail investor like you, and I do not have substantial investments in any of the scripts in any asset class to actually materially move any market. So all my suggestions, all my strategic advices that I'm going to give you in this channel are going to be completely unclouded from any kind of bias or my own conflict of interest. So whenever you want to take advice from any investment group, be it from any news channel or be it from YouTube or anywhere, you need to make sure, number one, the person is not invested substantially in the script or the asset class that you are going to invest in, and number two, the person does not have any plan of investing in that. So for example, if the person gives you a certain level to invest in, say for example he gives you a buying level, a limit order level, so it may so happen that the person has a target set for him as a selling price for that. So whenever you want to buy that at that level, he will put his sell order, and due to the impact cost, the price will fall sharply and your average price of the order will get drastically reduced. Now coming back to the meat of the video, this IPS which the fund managers or the portfolio managers build are built taking in consideration of the client's complete detailed information, the clients being the institutional ones, it may be the pension funds, or it may be any other huge clients. For these, they take the detailed information of those clients in terms of their finances, their goals, their risk and return objectives as well as constraints. So similarly, you have to understand your own goals, limitations, constraints, and what you are trying to achieve in the short as well as in the long term, and what are your intermediate liquidity constraints as well, because based on these parameters actually an optimum mix or the asset allocation is made out. So now, why only the huge investors, the big boys or the smart money, the institutional investors have their IPSs mandatorily and not the Tom, Dick and Harry of the capital markets like you and me, because they have huge amount of money invested in that particular fund, and what happens is even if there is a slight deviation from the investment philosophy or the strategic allocation that has been put in the IPS, there is a huge loss of investor faith. Whoever is investing money for that institutional client will have their faith altered and they might withdraw all their money. So there is a risk of loss both for the fund manager perspective as well as for the institutional investor. In the case of pension fund, for example, salaries go into the EPF account. That EPF account is maintained by a pension fund, and that pension fund actually employs a fund manager to handle that account, to invest that amount of corpus into a safe strategy so that there is least volatility available for that investment. So if that objective and those constraints of volatility is not maintained and the investment manager or the portfolio manager looks for exceedingly high returns which the employees are not certain about what is going on at the back, what will happen is there will be a surge of volatility that may replicate the VIX, and what will happen is the pension fund will notice it and they will withdraw money from the fund manager. Similarly, no matter how big your investment is, it may be 1,000 rupees, it may be 1 lakh, it may be 10 crore, doesn't matter. Every money you have to earn, right? So you don't want any money to be spent in a way that you don't have enough information about them. So you need to invest in a way that strategically aligned with the investment philosophy and the policies that you have laid out well before investing in the first place. Does it mean that the investment philosophy or whatever allocation that you have decided based on your risk appetite and your risk taking ability and the goals you have or the constraints you have are all set in stone? Absolutely not. Whenever the market presents an opportunity to you, for example, you have an allocation of 50% to equity. In March 2020, you see the market crashing down to 7,000 odd levels, and you see there is enough value offered by stocks such as HDFC, Bajaj Finance, etc. You can definitely overload your allocation to those kind of stocks. That does not mean if you are a heavily risk-averse investor, whenever you see the market crashing like that, you will not be able to invest huge sum of money in equity anyway. So in that case, your investment policy acts as a guideline to you about where to invest. But whenever the opportunity presents itself, you may deviate from the strategic allocation, what we call the tactical asset allocation. But you must have a timeline, you must have a catalyst well in place, and you should be able to understand that this is a short-term deviation, nothing more, nothing less. If you want to change the philosophy, you want to change the strategy mentioned in the document that you prepare for yourself, that this is the allocation that I want to maintain for equity, debt and gold, then in that case, just like the pros, you have to make the rebalancing in a very methodical, in a very scheduled way. So that rebalancing should be scheduled, say for example once in a year, or maybe once in 6 months or once in 3 months. If you are extremely risk averse, you can revisit the strategy even every month as well. But it should all be laid out perfectly in the IPS that this is your rebalance frequency. You want to take a look at the allocation every 6 months. You want to look at the allocation every 1 year, and then you want to go ahead and pick your stocks and pick the bonds, or even go venture out into cryptos if you want to mix them up. So to conclude, regardless of whether you are a retail investor or an institutional investor, in which case you won't be seeing this video anyway, am I kidding? You should be preparing a very cogent investment policy statement, or IPS, that will lay out the perfect pathway for your investment journey, and that will help you in tracking your investment decisions in a better way. Also, giving that word of caution again, please make sure the advices and the tips and signals that you follow from different PMSs, investment gurus, etc. perfectly fits with your investment policies and your investment philosophy, and they are not outliers as per your investment policy. They should fit your asset allocation, and you also check that the person who is giving such advices are unbiased, they do not have enough material holdings, nor are they interested in keeping such holdings in the near future. Thank you all. This will be it. Feel free to share it with your friends and acquaintances who have just started on their investment journey or are well on their course in their investment journey into any asset class. Also, please drop in your comments in the comment box depicting whether you agree or disagree with my views. These are actually not my views, but these are all the structures, methodologies, and the advices that are laid out by the CFA Institute in their curriculum, as well as are practically followed by all professional investment community. So be rest assured to trust on its authenticity. See you guys in the next video. Keep following this channel to get more videos like this.